Assalamu alaikum everyone. In today's class, we'll be solving Financial Management Pre-March 2026 mock examination. We're going to solve Nanda Stores, which is the first question from the section C of your exam. And Nanda Stores is basically a very straight, simple, and I can say to the point question. You can say of capital investment appraisal topic. It tests everything. It does not go too deep in the knowledge. It does not go too deep in the logics or details. It it keeps itself grounded, basic, and to the point. So we're going to jump straight to the question now. I'm not going to read the question fully. I'm just going to pick the things that we need in the answer, and I am going to solve the answer, and you're going to just look at it. You're going to look how and where we are applying the formulas, what we are doing, and how to use the CBA platform. Basically, the platform, the screen that you're seeing in front of your screens in your video on the YouTube channel or on my LMS, the screen that you're seeing is going to be the same screen that you will be greeted with in your CBA examination of financial management. So now let's jump straight to the question. Nanda Stores is a community-based supermarket that works with local suppliers to bring their produce to the market. It's expanding its operations and is considering setting up 10 stores in the south of its country. So basically, we are planning to expand. Now, because it is expansion, our cost of capital is going to remain the same. We are in no need to change the cost of capital. Now, in this third paragraph, we have the targets which the company has that, okay, our target payback is 2.5 years, target growth is 25%, and the finance director suggests that NPV and IRR should be calculated so that a full picture of the investment potential and financial acceptability can be seen. Now, the expansion will cost 330 million paid at the start of the first year. Now, start of first year is end of year zero. Our NPV calculations are always done on year-end basis. So year-end of zero is going to be the start of first year. So 330 million goes straight into the year zero. Now we have nothing here. So 0, 0, 0, 0, and 0. Now you can see that the project is for 4 years. See, as reinvestment in stores will be required every 4 years, the company evaluates investment over a 4-year time horizon. But I have made my format for year till year 5. Now, why is that so? Because in the question, you can see in the second last paragraph, Nanda pays corporation tax of 20% per year, 1 year in arrears. So because we are going to pay 1 year in arrear, that is why we're going to go further. The profit on year 4, the tax on profit on year 4 is going to be paid on year 5. That's why I've included year 5 in my format. Now, the NRV assumes a nil NRV. So NRV year 0 on year 4. 0, 0, 0, 0, 0, and 0. Now, Nanda Stores has prepared the following forecast for contribution and incremental fixed cost at current prices of the 10 store program over 4 years. Inflation is estimated to be 4% on contribution and 3% on fixed cost. So now, in this question, the examiner is testing incremental fixed costs, incremental end contribution, and inflation. Now, we know that the inflation on contribution is 4% per year. Now, because the inflation is 4% per year, so what is going to be our first year? Because these are the current prices. The 80 contribution of 80 is in current prices. So because we have to inflate them now, the inflated contribution is going to be 80 multiplied by 1.04. Now, I have I have linked it with working one. So let's just jump straight to the working one. Working one contribution. So see, our contribution here is 80, 160, 180, and 200 as per the table for year one, two, and year one, year two, year three, and year four respectively. Now, the question says that inflation is 4% per year. So 1 plus 4% is going to be 1.04. Now 1.04 multiplied by 1.04 gives you your inflation for year two. You multiply it three times, you get for year three, and you multiply it for four times, you get for year four. Now, inflation, I multiply this inflation factor with the contribution, I get the inflated contribution of 83.2, 173.06, 202.48, and 233.97. Now, the most the most desirable way to include your answers from your workings in your net present value table is by linking them so that the examiner can see that you have technical skills required by an ACCA student. So now year zero is zero, year one is, we're linking year one here is equals to C21, B21, C21, D21, and E21. And for year five, in zero. Now, the same is going to be for the fixed cost because the fixed costs were given to us were of current prices. See, has prepared the forecast of contribution at current prices. Now we need the inflated fixed costs. So what is our fixed cost? 50, 50, 50, 50 for one to year four. Inflation factor, same way we calculated this. I'm going to calculate it using the same way 1.03, 1.03 multiplied by 1.03, multiplied thrice, multiplied four times, and multiply your fixed cost with your inflation factor. You get your inflated fixed cost now. This is B27. So now the most desirable way is linking it. C, D, and E27. 0 now is equal to sum bracket open. This bracket close. Now, yes. One thing, I'm making this correction. One thing, whenever you're linking costs, just press minus after your is equal to so that you can get them in negative. This way you can solve your whole answer easily just by using one formula of sum rather than adding and subtracting each of them separately. Is equal to sum bracket open. This C4 to C7 is equal to sum bracket open D4 to D7 E4 to E7 is equal to sum bracket open F4 to F7 and is equal to sum bracket open G4 to G7. Now, we have our operating profits, operating cash flows. Now, what I'm going to do is I'm going to copy these values and I'm going to, sorry, I'm not going to copy them, I'm going to link them. What are my operating cash flows for year one? Year one operating cash flow is in C8. So C8 is equals to D8 is equal to E8 is equal to PF. Now, tax on operations. We pay a corporation tax of 20% for 1 year and 1 year and 8 years. So see, my year one operating cash flow is 31.7%, 31.7, and my tax rate is 20%. But I'm going to pay this tax in year two. Same year two, multiply by this on year three on year four, and year four on year five. Now this is on C, this is B30, this is 33 cell number. So what I'm going to do is, because these are costs, what I'm going to do is equals to minus C33 is equal to minus D33 is equal to minus E33 is equals to minus F33 is equal to 1. Sorry, 1 is 0, minus C33 is equal to minus D33 is equal to minus E33 and it is equal to minus F33. Now, Now, because we're making an investment and any sort of investment has a depreciation, depreciation is a tax allowable expense. So we get tax benefit or tax saving from that tax allowable depreciation. Now, what is the say working for tax saving? Now, a depreciation is 25% straight line. So 330 multiplied by 25% gives you 82.5 million. 82.5 million multiplied by 20% gives you 16.5. Now, the 16.5 is going to be our tax saving, but it is also going to be in arrears because everything which is tax related for Nunda Corporation is in arrears. So this is C39. 0, 0 is equal to C39, D39, E39, and F39. Because this is a benefit, this is going to be positive. Now, our operating cash flows were this. How to calculate net flow is equal to sum bracket open operating cash flow with the tax. Everything that was tax rate is equals to sum bracket open is equal to sum bracket open sum bracket open and is equal to sum bracket open. Now, what I'm going to do is I'm going to select all these cash flows and I'm going to format them to two decimal places so that my calculations get easy. Now, how much is the discount factor? Nanda currently uses a 10% as the nominal after-tax discount rate to appraise investments. So 10%. Now, one way to calculate NPV is I write separate discount factors in each cell and then multiply each of my net cash flows with that particular discount factor and then add them all together to get my NPV. This is the traditional way. Now, because you're studying with me, you're studying from Sir Daniel, you're studying with someone who incorporates every technical skill in your answer, who asks you to make sure that you solve your exam just like you are solving a huge financial crisis for your company. What will you do? You will use as much formulas in your Excel as possible. Now, only the formulas that are allowed by the ACCA. What I mean is The formula for NPV and IRR are the formulas that are allowed by ACCA and your board to be used in your exam, because this shows that you have technical prowess that is required for an ACCA qualified student. Now, is equals to NPV bracket open. This is my discount factor multiplied by these are my. Now I'm going to select my cash flows from year 1 to year 5 only. And then what I'm going to do is I'm going to press plus and then I'm going to select my year 0. This gives me a net present value of 12.45. Now I'm going to keep it. I'm going to write it somewhere with this. Now I'm going to just remember this 12.45. Okay. Now one, I'm going to solve this using the traditional method. One, uh, 1, 0.909, 0.826, 0.751, and 751, 0.683, and 0.621. Now, E is equal to this multiplied by this, equal to this, multiplied by this. Now what I'm doing is I'm going traditional way and multiplying each cash flow with its respective discount factor so that you guys can understand what is the difference is equal to sum bracket open bracket close. See, what you got is 12.34, 8.2, 107.52, 105.39, 112.44, and 11 point. Now, what you get here is 12.34. What we got previously was 12.45. Now, what was easier? Which one was the easier? Applying the formula. Now, remember when you apply the NPV formula, it is equals to NPV bracket open, discount rate, comma, your cash flows from year 1 till your useful end of useful life, bracket close, plus your year 0 cash flow. This gives you your NPV. Now, this was part 1A1 of end of the question 1 from section C. What we're going to do is part A, part A2. That is internal rate of return. Now, I am going to teach you the easiest way possible for this kind of question. What you're going to do is now, what you're going to do is you're going to copy this first row, control C, and paste it in your part A2 here. and you're going to copy this line. Net cash flow, your discount factor, and your NPV. So C and is equal to B11, C11, D11, D11, discount factor of 25%. Because for IRR, you need two discount factors and two NPVs. Now, 10% you have a positive NPV. So this means that when your discount factor goes up, your NPV goes down. So you need a negative NPV so that you can apply it in the IRR formula. So now is equals to NPV bracket open. This is your discount rate. These are your cash flows from year one to year five plus year zero. This gives you the 8.2. Now, once again, I'm going to make these values limit to two decimal places. That calculations are easy. Now we have two NPVs and two discount factors. So for IRR, what we're going to do is, sorry for that glitch. So what you're going to do is, we're going to is equals to, this was your lower rate, is equals to, this is your lower rate, bracket open. This is your oh, lower rate is equals to the lower NPV divided by bracket open, lower NPV minus, sorry, NPV on lower rate minus this bracket close, multiplied by higher rate minus lower rate, bracket close. Okay. So this was us. What we get here is, wait a second, I guess there's this, sorry. Yes. So there was no error. This is the formula. Lower rate plus bracket open. NPV on lower rate divided by bracket open. NPV on lower rate minus NPV on higher rate, bracket close. Bracket close multiplied by bracket open. Higher rate minus lower rate, bracket close. Press enter, you get your IRR. Now, this is the answer. So you're going to highlight this. You're going to bold this. And we are going to remove our highlight. Um, Part A3 is payback period. Part A3 is Payback period. Wait a second. Yeah. That's part A3 is payback period. Now, year 0 minus 330, year 1 is how much do we earn in year 1? 1.7. Year 2 is 130.17. Year 3 is 140.34. The 4 is 164.63. Year 5 is 19.0. Negative. Minus 19.0. Now, so mention the years here. At year 0, our payback is simple. Minus 330. Wait a second, guys. Okay. Particulars, cash flow, remaining. Now year 1 is minus 330. At year after a year 0, we are minus 330. At year 1, we're going to be at this plus this 298.3. So we haven't gotten our payback yet. Then we just plus year 2. After year 2, we are at 168. So we haven't gotten our payback yet. So we are going to use year 3. Okay, we haven't still gotten our payback yet, but our year 4's cash flow is going to be higher than our remaining balance. So what we're going to do is after year 3, what we're going to do is the remaining balance, that is is equals to 779 divided by 100. That is 160.63. 160.63. This will give us at point how much point period you will earn remaining balance. That is 0.17 years. So what we are getting our payback is payback period is 3.17 years. Okay, now part A, four. That is rows. Now our average investment is equals to bracket open 330 plus 0 bracket close divided by 2. That is 165 million. And what is our total average uh, profit is equals to total operating cash flow minus total depreciation. So our total operating cash flow is equals to sum is equal to bracket open sum bracket open. These are our total operating cash flows minus 330 is our total depreciation. So that gives us our total profit at 147.4, and to average it, we're going to divide it by 4 because this is for 4 years. This gives us a 36.81181 average annual profit. Our average annual profit is 36.81. Our average investment is 165. So what is our average? What is our ROS going to be? Is equals to this divided by this and convert it into percentage. This gives us a ROS of 22.31%. That is for part A of question number 1 of section C. For part 2, that is discuss the suitability of the techniques used in part A. You're going to write the benefits, which is the advantages and disadvantages of all the techniques that were used in part A, that is NPV, IRR, payback, and ROS. Now we all know that NPV is the most sound method. It it incorporates the time value of money, but the drawback is that it assumes inflation to be same, or it and IRR does not give you any financial answer of your question of investment. It just gives you that, okay, at what percentage your NPV is going to be zero. Payback period ignores time value of money, and return on capital employed can be manipulated by accounting policies of depreciation. Okay. Now, each of the advantages and disadvantages are mentioned in my theory book, which is attached on my LMS. This video is for the CV platform so that you guys can be aware. I'm going to post this video on YouTube as well so that you can benefit. Till then, take care. Now I'm going to see you in the next one. Then take care and goodbye.